Hello everyone, good day. This is InFulfillment for International Business and Trade Reporting. Before we will continue to our discussion, let me introduce myself and my reporters first. I am Jubelira Picolana and my co-reporters are Miraflor M. Iglesia and Princess Karen F. Suarez. Please take note that the topics and discussion we will give are all based from our research and understanding. References are given in the last part of our report. If there are any misconceptions, we are open to be corrected. Thank you. Table of Contents: Global Financial Market and Institutions, Introduction to Global Financial Market, Introduction to International Money Market, International Bond Markets, and References. So we will be discussing about Global Financial Market and Institutions. Introduction to Global Financial Market. So what does it mean? Based from our research, it is a broad term describing any market place where buyers and sellers participate in the trade of assets such as equities, bonds, currencies, and derivatives. Financial markets are typically defined by having transparent pricing, basic regulations in trading, costs and fees, and market forces determining the prices of securities that trade. Structure of financial markets. Financial markets comprise 5 key components, namely debt market, equity market, foreign exchange market, mortgage market, and derivative market. Debt market is the market where debt instruments are traded. Debt instruments are assets that require a fixed payment to the holder, usually with interest. Examples are bonds. Interactions between investors and borrowers in the bond market determine interest rates. The debt market is important to economic activities because it provides an important channel for corporations and governments to finance their operations. Based on our research, the size of the world bond market was estimated at around $37 trillion at the start of 2002. All currency figures are in US dollars. Second structure is equity market. Is a market in which shares of companies are issued and traded, either through exchanges or over-the-counter markets, also known as the stock market. It is one of the most vital areas of a market economy. Equity instruments are traded in the equity market. It refers to a document which serves as legally applicable evidence of the ownership right in a firm, like a share certificate. Example of equity market is common stock. Next is foreign exchange markets. It is where currencies are converted so that funds can be moved from one country to another. For example, one can swap the US dollar for the euro. So it is according to our study, guys, that there are actually made up of many different markets ang foreign exchange market. For example, kay ang euro o ang US currency. So each of them constitutes a market. So Forex or FX market, institution for the exchange of one country's currency with that of another country. Foreign exchange transactions can take place on the foreign exchange market, also known as the Forex market. The Forex market is the largest, most liquid market in the world, with trillions of dollars changing hands every day. So next is mortgage markets. It is a collection of markets which includes a primary or origination and a secondary market where mortgages trade. A mortgage is a pledge of property to secure payment of a debt. Property. Pledged as collateral is real estate, which is often in the form of a house. That is the loan given to the buyer of the house by a lender. If a homeowner or the mortgagor fails to pay the lender or the mortgagee, the lender has the right to foreclose the loan and seize the property in order to ensure that it is repaired. Derivative market. According to Wikipedia, the derivatives market is financial market for derivatives. Financial instruments like futures contracts or options, which are derived from other forms of assets. The market can be divided into two, that for exchange-traded derivatives and for over-the-counter derivatives. So here, I've researched an image or an other meaning of derivatives market. And this one, examples of derivative examples. Forwards, futures, options, and swaps. These are contracts. So forward contracts are over-the-counter instruments. Futures, it is traded through the exchange. It becomes a future contract. Options contract offer the buyer the possibility to buy or sell depending on the type of contract. Lastly, the swaps. Swaps, one party pays a flexible interest rate and the other pays a fixed interest rate. Role of financial market. Mobilization of savings and their channelization into more productive uses. It is giving impetus to the savings of the people. This market takes the uselessly lying finance in the form of cash to places where it is really needed. Facilitates price discovery. The price of any goods or services is determined by the forces of demand and supply. Like goods and services, the investors also try to discover the price of their securities.
So in the continuation of the topic, I'm going to discuss to you the recent trends and also the impact of globalization in financial markets institution. So let's continue about the recent trend, which have 4 parts. Continued growth of global financial assets, depth of financial markets, regulation of financial securities, risk, and the level of foreign investment. So, continued growth of global financial assets. So today, global financial markets are at inflection point. One path leads to a more balkanized structures that relies primarily on domestic capital formation and concentrates risk within local banking system, while another points towards a healthier model of financial globalization that corrects the pre-crisis excesses while supporting more robust economic growth. Achieving this second outcome will require concerted action by policymakers and financial institutions. So, depth of financial markets. So, financial depth captures the financial sector relative to the economy. It is the size of the banks, other financial institutions, and financial markets in a country taken together and compared to a measure of economic output. More specifically, the variable is defined as domestic private credit to the real sector by deposit money banks as percentage of local currency GDP or gross domestic product. The private credit therefore exclude credit issued to governments, government agency, and public enterprises. It also includes credit issued by central banks. So, regulation of international securities market. So this video provides an analytical frameworks for evaluating these conflicting approaches to the international regulation of financial services. So in this video, I focus primarily on securities market, but the lessons are valid for the financial services as well. So let's talk about the types of regulation. So types of regulations, one of this is economic regulation that usually involves limitation on prices, profits and or entry into an exit from an activity. So next is health, safety, environment or HSE regulation. Typically involves mandated changes in production process and or product qualities or types. And then lastly is information regulation that typically involves the requirement that seller attach specified types of information to the goods and services that they sell. So raise in the level of foreign investment. So what happened when FDI increases or foreign direct investment increases? So an increase in FDI will increase the demand for the currency of the receiving country and raise its exchange rate. In addition, an increase in a country's currency will lead to an improvement in its terms of trade, which are the ratio of export to import prices. So next is impact of globalization on financial markets institution, which have two types: financial integration degree to which capital can flow between financial markets, and intermediaries obtain the disbursed funds around the globe. So let's talk about financial integration degree to which capital can flow between financial markets. So in integrated financial markets, a domestic investor can buy foreign assets and foreign investors can buy domestic assets. Among countries that are fully integrated into world financial markets, assets with identical risk should command the same expected return regardless of location. But how does one determine exactly when a market becomes integrated? Often the date of certain regulatory changes is used as a proxy for the timing of integration of equity markets. There are many ways to circumvent capital controls and thus to gain indirect access to financial markets even when a market is technically closed to foreign investors. So let's proceed about the intermediaries obtain and disperse funds around the globe. So, financial intermediaries serve as middlemen for financial transactions, generally between banks or funds. These intermediaries help create efficient markets and lower the cost of doing business. Intermediaries can provide leasing or factory services but do not accept deposits from the public. Financial intermediaries offer the benefit of pooling risk, reducing cost, and providing economies of scale among others. So guys, good morning. I am Princess Karen F. Suarez. So I'm going to discuss the introduction of international money market. So the structures and the features and also the international money market instruments. So let's proceed to introduction to international money market. The market in which participants from around the world are able to buy, sell, exchange, and speculate in different currencies. International currency markets are made up of banks, commercial companies, central banks, investment management firms, hedge funds, retail forex brokers, and investors. So here is the structure: international money market, down to global financial market, to global foreign exchange market, and international capital market. So international money markets where the world are able to buy and sell, etc., down to global financial market. So global financial markets includes market for foreign exchange, the euro currency and related money markets, the international capital markets, notably the Eurobond and global equity markets, the commodity markets, and the last but not the least, the market for the forward contract options, swaps, and other derivatives. So let's down to the global foreign exchange market, where the foreign exchange market is a global decentralized or over-the-counter market for the trading of currencies. This market determines the foreign exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at current or determined prices. And last but not the least is international capital market, that financial market or world financial center where shares, bonds, debentures, currencies, hedge funds, mutual funds, and other long-term securities are purchased and sold. International capital market is the group of different countries' capital market. So that's the structure of international money market. So what are the features of international money market? So one is existence of central bank, 2 highly organized commercial bank, 3 existence of sub-market, 4 healthy competition in sub-markets, 5 integrated structures of money market, 6 availability of proper credit and structure, 7 adequacy and elasticity of funds, 8 international attraction, 9 uniformity of interest rates, 10 stability of prices, and last 11 highly developed industrial system. So let's explain the first, existence of central bank. In the developed money market, the role of central bank is notable. It controls the entire money market operations by making the availability of funds depending upon the economic cycles. It can be done through its open market operations. Then highly organized banking system. Number 2. As they are the main dealers in short-term funds, the commercial banks are considered as nervous system of the money market. Therefore, a well-developed money market will have a highly organized and developed commercial banking system. 3. Existence of submarkets. In developed money markets, thus various submarkets existed and functioning smoothly. That is, the money market will have a developed submarkets such as bill market, call money market, acceptance market, discount markets, and etc. It can be said that the larger the number of submarkets, the broader, the more developed will be the structure of the money market. So number 4, prevalence of healthy competition. In each submarkets, there should be a reasonable and healthy competition. That is, in a developed money market, there are a large number of borrowers, lenders, and dealers. Then only each market will be active enough to achieve the purpose of its existence. 5. Integration of submarkets. In the developed money market, there will be a perfect integration among various submarkets of the money market. Their functioning are interdependent. The funds flow from one submarket to another, and the activities of one submarket should create effects in the other markets also. 6. Availability of proper credit instrument. The developed money market should have the necessary credit instruments such as treasury bills, promissory notes, bills of exchange, and etc. They should be freely available. 7. Flexibility and adequacy of funds. In a developed money market, there must be ample resources. The flow of funds into the money market should also be flexible enough. For example, the flow of funds can be increased or decreased depending upon the demand of funds. So let's proceed to number 8, international attraction. The developed money markets attract funds from foreign countries also. The dealers, borrowers, and lenders of foreign countries are eagerly coming forward to participate in activities of developed money market. Number 9, uniformity of interest rates. Prevalence of uniformity and interest rates in different parts of the community of the country is that characteristic feature of developed money market. Number 10, stability of prices. Stability of prices all over the country will be an outcome of the effective functioning of developed money market. And number 11, the last but not the least, highly developed industrial system. The money market will function smoothly and can achieve the basic parts of its existence only when there is a highly developed industrial system. Developed money market demands for such a system. So this will be the last topic that I'm going to discuss. International money market instruments. There are 6. 1. Euro currency. 2. Euro credits. 3. Euro certificate and deposits. 4. Bunkers and acceptance. 5. Floating rates note. And 6. Euro commercial papers. So first, euro currency. Euro currency is a currency that is deposited at a foreign bank outside of its home country. Contrary to its name, the term does not refer to euros that are deposited outside of Europe. It is a general term that applies to all currencies that are deposited anywhere outside of its local country. Next is euro credit. Euro credit refers to a loan whose denominated currency is not the lending bank's national currency. The concept is closely linked to that of euro currency, which is any currency held or traded outside its country of issue. So a euro certificate of deposit is a negotiable fixed or floating rate interest-bearing certificate of deposit issued by banks in a bearer form at par with interest and principal paid in euro currency, and an interest rate pegged to LIBOR, commonly in denomination of $1 million and a maturity of less than 6 months. Next, banker's acceptance. A banker's acceptance is an instrument representing a promised future payment by a bank. The payment is accepted and guaranteed by the bank as a time draft to be drawn on a deposit. The draft specifies the amount of funds and the date of the payment and the intensity of which the payment is owed. Number 5. Floating rate note or FRN. So a floating rate note is a bond that has variable interest rate versus a fixed rate note that has an interest rate that doesn't fluctuate. The interest rate is tied to a short-term benchmark rate such as LIBOR LIBOR or the Fed funds rate plus a quoted spread or rate that holds steady. So last one is Euro commercial paper or ECP is a form of unsecured short-term loan that is issued by a bank or corporation in the international money market. Notably, ECPs are denominated in a currency that is different from the domestic currency of the market where the paper, the securities, or bond is issued.
Hi everyone, I am Mira Permendez Seglacia and I will be reporting the international bond market, the international equity market, the impact of globalization on investments, as well as the impact of globalization on corporate finance. And now, let's have a short overview about international bond market. So, international bond market brings together borrowers and investors from different national jurisdictions. Despite the complexity associated with the bond market, a bond is simple and it might be considered a bit boring when compared to a stock. After all, a stock represents a piece of company's wealth only. International bond market. So what is international bond market all about? It is a financial market where participants buy and sell debt securities are usually in a form of bonds. Also, a bond issued in a country or currency other than that of the investor or broker. A bond market also is much larger than equity markets, and the investments are huge too. However, bonds based on maturity, and they are traded for short time before maturity in the markets. That's the reason why governments typically issued bonds in order to raise capital to pay down debts or fund infrastructural improvements. An international bond market is further classified into three types. First, Euro bonds. Second, foreign bonds. And third is the global bonds. Let's proceed to the first type of an international bond market, which is a Eurobonds. So what is a Eurobonds all about? A Eurobond issue is one denominated in a particular currency but sold to investors in national capital markets other than the country that issued the dominating currency. Other than that, Eurobonds are frequently grouped together by the currency in which they are denominated, such as Euro-dollar or the Euro-yen bonds. Since Eurobonds are issued in an external currency, then they are often called external bonds. We should take note of this, that Eurobonds are important because they help the organization to raise capital while having the flexibility to issue them in another currency. One of the example of a Eurobonds is a US-based firm issuing US dollar bonds in Europe and Asia. The second type of an international bond market is a foreign bonds. So what is a foreign bonds all about? A foreign bond is one offered by a foreign borrower to the investor in a national capital market and denominated in a nation's currency. That's the reason why foreign bonds are traded in the foreign bond markets. Here are the some special characteristics of the foreign bond markets. First, issuer of bonds are usually governments and private sector utilities. Second, it is a standard practice to underwrite and organize the underwriting the risk. Third, issues are generally pledged by the retail and the institutional investors. Also, domestic investors can diversify internationally by owning foreign bonds, and since they are traded on local exchanges that are easier to acquire. In other words, foreign bonds are issued by a foreign government or a corporation in the domestic market. Here are the example of a foreign bonds. First, Bulldog German firm issuing GBP bonds in the UK. Second, Yankes French firm issuing US dollar bonds in the US. And lastly, the Samurai bonds US firm issuing GPY or the yen bonds in Japan. The last type of an international bond market is the global bonds. So what is a global bonds all about? It is a bond issued and traded outside the country where currency is denominated. This type of bond is issued by a non-European company but sells in a European country or any other foreign market. Global bonds are sometimes referred to as a Eurobond. In other words, global bonds are issued in both domestic and international markets. For example, a US corporation can issue a bond in Europe, so these bonds are sold in various maturities and credit qualities. Who are the international bond market participants? Bond market participants are either buyer or the debt issuer or sellers or the institution of funds, and often both of these. Participants include institutional investors, governments, traders, and individuals. Since there is a specificity of individual bond issues and a condition of lack of liquidity in case of many smaller issues, a significantly larger chunk of outstanding bonds are often held by institutions, such as pension funds, banks, and mutual funds. In the United States, the private individuals own about 10% of the market. And now we are done with the international bond market. So let's proceed to the international equity market. So what is an international equity market all about? International equity market in which shares are issued and traded, either through exchanges or over-the-counter markets. Equity market are also known as the stock market. It is one of the most vital areas of a market economy because it gives access to capital and investors a slice of ownership in a company with the potential to realize gains based on its future performance. As what I have understand about equity market also, in which it is a meeting point for buyers and sellers of stock. The securities are traded in the equity market can either be public stocks, which are those listed on the stock exchange, or privately traded stocks. Often, private stocks are traded through dealers. I have mentioned in the definition of international equity market, where equity market can also be represented as a common point where sellers and buyers of the stock meet to trade. So here is an elaboration on the subparts of an equity market. First, the stock exchanges. The primary purpose of channelizing trading through stock exchanges is to keep the process of trading fair and ethical. Traders buying or selling securities through these exchanges can thus assume protection as it mandates companies to abide by certain standards. Under this purview, a stock exchange facilitates trading of stocks, securities, and derivatives. The second subparts of an equity market is the over-the-counter markets. Over-the-counter markets do not lay down such stringent rules as exchanges and offer comparatively lesser privacy to both traders and listed companies. Although, an alternative to stock exchanges where companies can remain listed, the absence of transparency makes over-the-counter market less popular than exchange for traders. Since we have already been discussed the international bond market and the international equity market, and now we will move to the impact of globalization on investments. As we all know that globalization has resulted in greater interconnectedness among markets around the world and increased communication and awareness of business opportunities in the four corners of the globe. More investors can access new investments, opportunities, and study new market at a greater distance than before. Potential risks and profit opportunities are within easy gear to reach. So here are the impacts of globalization on investments. First, reason to include foreign assets in a portfolio. Second, diversification. Third, market performance. Fourth, ways to achieve international diversification. Fifth, direct investment in a stock traded on foreign exchanges. Sixth, investing in foreign securities traded on domestic exchanges. 7. Investing in investments companies that invest in foreign securities. And lastly, changes in foreign exchange rates can dampen or amplify the impact of foreign investments. Lastly, we will discuss the impact of globalization on corporate finance. Globalization and financial stability is one specific mechanism through which globalization can affect economic growth, poverty, and inequality, and its impact on financial stability. Financial crises can result in a permanent loss of income, have a devastating effect on poverty, and increase inequality. So here are the impact of globalization on corporate finance. First, risks associated with international business activity. Second, political risks. Third, social risks. Fourth, economic risks. Fifth, forms of international business activity. 6. Exporting and importing. 7. Operating subsidiaries in foreign markets. 8. Selling in foreign markets. And lastly, financing from foreign sources.